Hello, everyone. This is Brandon Wendell, and I wanted to just invite you to my signature series that's going to be coming up to an online training academy center near you. A couple of people asked me, what is this all about? Why should I bother joining this? Am I going to get anything out of the class? And the answer is absolutely not. It's completely worthless. No, just kidding. Anyway, what you're going to learn, as you can see on the screen, we've got quite a few topics that I'm going to be going over in that class over 3 days. Part of it, we're going to be looking at how to read the charts from a little bit more closer standpoint, understanding price a little bit better. And let me just actually, instead of just talking about this, let's go ahead and take a look at some of this stuff. If we go into some of our charts here, say for instance, I've got the S&P futures chart and I want to know what's likely to happen with the trend, I can look at something as simple as the color, shape, and size of the candles. And looking at those things, the color, shape, and size of the candles gives me a lot of information about what's going on. Something as simple as, when I enlarge this a little bit here, you can see how the green candles were dominant. Well, that means you're in a bullish trend. And as soon as we start seeing multiple reds creeping in, the trend is starting to shift. And eventually, the trend gets dominated with red, and we are likely to start moving to the downside. So that's one thing that we start talking about. Another thing we look at, and you'll actually see that on the bottom of my screen, is something called the RSI. And the RSI is something that many people are familiar with in trading, but they don't use it properly. As a matter of fact, many people use many of the tools improperly when it comes to indicators. The RSI is a momentum indicator, and looking at things like what you're seeing on my chart here, I actually had a warning sign. In addition to the colors of the candles shifting, we had what is called a negative divergence. And looking back, if I could find things like negative and positive divergence, those are signals that usually precede a change in trend. And that's obviously what we're looking for, is trying to figure out, okay, is the trend going to change on us? And if so, where and when is it going to change? Something as simple as this. Right here we see another instance of divergence where you have prices moving to the upside, like that. However, the indicator is showing the same momentum as before. Well, if we're breaking out to new highs, you would expect prices to be doing that with increased momentum, not less momentum. So what happened? Well, you can see prices pulled back pretty sharply afterwards. So we're going to go into a lot of things like that. Another piece that we're going to be looking at is I get a lot of students that tell me, Brandon, I swear, as soon as I downloaded my software, they put a camera on my computer because they say as soon as I get into price action, as soon as I get into a trade, I end up getting shaken out. Well, that's called the novice shakeout. What you're doing is end up trading with the novices in a manner that's very familiar to the professionals to be able to run your stops. And that's pretty much what it is. And right here you see the novice candle being formed on this particular breakout. One of the things you'll usually see accompanying this, and let's see if it's there, is an increase in volume. So if I take a look at my volume, yep, what do you notice right there? There's an increase in volume, much higher volume than we had previously. That's a warning sign for the pros to take advantage of the novices. What they do is they allow price to move a little bit. You think you're making money. All of a sudden, the novices get shaken out on a pullback. All the stops are run, and prices move higher without the novices on board. So that's another thing we're going to be exploring, a strategy that really entails how to trade that and be successful. Another thing we look for is correlations and how to deal with related securities and use that as an opportunity or even as an odds enhancer. Looking at this chart, I have several securities on top of each other. I've got the NASDAQ, the S&P, the Dow, and the Russell for the futures markets. And what I did with this percent change chart is I zeroed it out at a certain point. And what I can do here is look to see who is leading and who is lagging. And basically what we learn is how to follow the leader. For instance, from this point here on Friday, the leader to the upside is the Russell 2000. Well, that means all the markets will continue to move to the upside as long as the leader allows them to do that. But once the leader hits supply, all of the laggards will start to fall. So another thing we learned is how to use the relationships between related securities to be able to time turning points in the markets. And there's a lot more to this than just what I'm showing you. I'm just showing you some of the basics quickly here. The last thing that I want to go over real quick is what's called spread trading in futures. And the neat thing about these futures markets is they move, but the contracts don't always move at the same pace as you just saw with the relationships between related securities. So if I find two related securities and I study them, I can look to see, okay, these are both crude oil, by the way. I have CLF 20, which is the January 2020 contract, and I have the, oops, keeps jumping on me, the CLG 20, which is February 2020. And you notice as they move to the downside, the blue line, which is the January contract, moved faster than the February contract. Well, they'll eventually catch up with each other, but in the meantime, that offers an opportunity. We call that spread trading. And this is another way of looking at this. I've got the January versus the February contracts here, and I could have traded that spread as what they call a bear spread. And the interesting thing is, in the normal holding of a contract overnight, I would have had to come up with roughly $5,000 as a margin deposit. By doing it here, we could have done the same trade, a bearish spread trade, and only spent about $200 for margin overnight. Yep, that's right, only about $200. And the interesting thing is we would have made a lot of money here. It went all the way from 0.79 down to we'll call it 2. Okay, you're looking at about a 0.6 movement, which is actually 60 ticks or $600. So for that $200 investment, you would have made $600 rate of return. So anyway, that's a little bit more about what my signature series is all about. And if you want to learn more, contact your local center and find out. Hopefully I'll see you soon.